Ford carries $163 billion in debt, more than 3 times what it costs to run NASA for a year. And in 2025, it wrote down nearly $20 billion on electric vehicles it now admits it isn't going to sell. That single write-down was larger than the entire annual revenue of most Fortune 500 companies. Gone. Not deferred, not restructured, written off the books while the assembly lines it paid for sat idle. If your retirement portfolio holds any of the broad market index funds that count Ford, GM, or Stellantis among their top auto sector weightings, that capital destruction didn't just show up in a headline you scrolled past. It showed up in your quarterly statement, a line item you might not have traced back to a factory in Tennessee that was built to stamp out 1 million electric trucks and produced 10,000. The sticker price on a new car in 2019 was about $38,000, roughly what a loaded F-150 or a Chevy Silverado cost at your local dealer the last time you actually shopped for one without wincing at the number on the window. Today, that average has crossed $50,000, and the monthly payment on a new vehicle has hit $770. The cars didn't get twice as good. The balance sheets behind them got twice as fragile. I had this story half written under a different angle, a straightforward look at why car companies are struggling. Then I found the Stellantis Annual Filing, the one where $5.5 billion in profit turned into a $26 billion loss in a single year, and the angle had to change. This isn't a story about a bad quarter. It's a story about an entire industry that chased a valuation mirage, and the question it raises is whether anyone in charge understood what they were building or just understood what Wall Street wanted to hear. Here's what nobody in Detroit will say out loud. Every major automaker except Tesla made the same bet at the same time, for the same reason, using the same borrowed money. And they all lost. The question isn't whether the car market is broken. The question is whether the companies that broke it can survive long enough for the market to forgive them. And a harder question, what happens to the 60,000 supplier workers who've already lost their jobs since January if forgiveness doesn't come? Volkswagen alone has 100,000 employees staring at layoff notices right now. If you've spent a career watching American manufacturing promises evaporate, and you have, subscribe. One documented story like this every week, because the next filing deadline is closer than the last press release. The reason Ford can't outrun its own debt was decided roughly 5 years ago, in a boardroom where the math on the whiteboard was about stock price, not unit demand. And the people who approved it are still making decisions. The valuation chase. Ford CEO Jim Farley approved a $50 billion capital commitment to electrification between 2022 and 2026, a figure that exceeded the company's entire market capitalization at several points during the rollout. The logic was legible from the outside. Tesla's market cap had surpassed $1 trillion in late 2021, making it worth more than every legacy automaker on Earth combined, despite selling fewer cars in a year than Ford sold F-150s. Shareholders didn't just want EVs, they wanted Tesla's multiple. You don't know this yet, but the restructuring document Ford files 18 months into this bet, the one that kills several all-electric models simultaneously, contains a line about it challenge and demand realities that will cost the company more to write than the vehicles themselves ever earned. GM followed the same playbook. Mary Barra pledged $35 billion toward an all-electric future by 2035 and broke ground on battery plants through the Ultium joint venture in Lordstown, Ohio and Spring Hill, Tennessee. Stellantis, under Carlos Tavares, committed billions more across 14 brands. Honda partnered with GM on shared EV platforms. The entire industry moved in lockstep. Not because consumer demand surveys supported it, but because equity analysts rewarded the announcements with higher price targets.
Somewhere in Indiana, a union assembly worker watched the retooling begin. The plant where that worker had built combustion engines for 15 years was being converted to produce electric F-150 Lightnings, new robotic welding cells, new battery pack integration lines, new training modules. The promises were specific. This was the future. This facility would lead it, and the jobs were secure. That worker's name doesn't appear in any SEC filing. Their pension contribution, however, runs through the same balance sheet Ford now uses to service $163 billion in outstanding obligations, a debt load so large that interest payments alone consumed roughly half the company's free cash flow last year. The early adopter math told a convincing story. For about 18 months, EV sales climbed, waitlists formed. But by late 2023, something shifted that the capital deployment models hadn't anticipated. The early adopters who wanted an electric vehicle had already purchased one. The next wave of buyers, the ones who needed range confidence, charging infrastructure, and a price point under $40,000, weren't materializing at anywhere near the projected rate. Cox Automotive research showed that existing EV owners themselves were considering switching back to combustion or hybrid vehicles. The market wasn't expanding. It was subdividing a fixed pool of demand among more brands. The memo circulated internally before the public pivot. It hasn't surfaced in any filing yet. Synchronized retreat. Stellantis leadership declared the company was committed to its EV transition strategy, projecting a profitable all-electric future that justified billions in capital allocation across its 14-brand portfolio. The record shows something different. Stellantis reversed course so completely that it converted a $5.5 billion annual profit into a $26 billion loss. And roughly $25 billion of that figure represented write-downs on EV infrastructure the company simply walked away from. Not sold, not repurposed, abandoned on paper, while the physical assets sat in place, depreciating. The short sentences come first. The retreat was coordinated. The losses were real. The timing was not accidental. Set the numbers aside for a moment. Think about the last time you walked a dealer lot. Really walked it, not browsed online, but stood on asphalt under those white lights and looked at window stickers. In 2019, you could configure a well-equipped pickup for $38,000 and the monthly note landed around $550. Today, the average new car payment is $770. The average used car payment is $531. 1 in 5 buyers now signs a note above $1,000 a month. And the loan term after refinancing averages over 90 months. 7.5 years of payments on something that loses a quarter of its value the moment you pull it off the lot. I'll be honest, I didn't expect the refinancing number to be this stark. 90 months. That's not a car loan. That's a second mortgage on something with no foundation. Here's what makes this worse than a pricing problem. The cars sitting on those lots in 2026 are not meaningfully better than the ones that cost $12,000 less 6 years ago. They have the same Apple CarPlay, the same safety ratings, the same efficient engines wrapped in interiors that would have been considered luxurious a decade ago. The sticker moved. The value proposition didn't. And the person standing on that lot, the person who remembers what $38,000 bought, knows it. Now return to the corporate side. Ford's electric vehicle division, Model E, lost $4.7 billion in a single fiscal year. GM quietly scrapped its pledge to go all electric by 2035 and wrote down approximately $8.7 billion in EV investments. Honda posted its first annual loss in nearly 70 years, pointing directly at the billions it had committed to EV readiness for vehicles it now won't produce. Every one of these companies cited the same cause. Every one of them moved at the same time.
They crossed the river together, knowing the shareholders were in the water, because no single company wanted to be the one that looked uniquely foolish. The herd provided cover, but the losses were individual. If you're watching companies destroy capital at this rate while financing the destruction with borrowed money, they'll need you, the consumer, to repay through higher vehicle prices. That's not someone else's problem. That's the price tag on your next car. Subscribe. One story every week, built from the filings these companies hoped you wouldn't read. Porsche's operating profit fell 99%. Ferrari's stock dropped 30% in 6 months. Even the ultra-premium segment, the brands built entirely on the premise that their badge justified a multiple of 6 or 8 over comparable performance, discovered that a Xiaomi SU7 from a company that didn't have a car division 5 years ago could outsell a Tesla Model 3 in China on specs alone. The board at Stellantis met in the same quarter it approved executive compensation structures. The $26 billion loss was in the same annual report, filed on the same day. The unraveling floor. In January 2026, the 60-day delinquency rate on subprime auto loans hit 6.9%, the highest level recorded in more than 3 decades of tracking. That number alone tells a story about what's happening underneath the sales figures that still look healthy on the surface. Roughly 31% of trade-ins toward new vehicles now carry negative equity, with the average underwater amount sitting at $7,200 per vehicle. That's not a consumer confidence problem, that's a structural trap. People owe more than their cars are worth, can't afford to trade up, and can't afford to stay in loans whose terms have stretched past 7 years. This is not a new story. It's a pattern with a specific genealogy. In 1963, Studebaker terminated its pension plan at its South Bend, Indiana plant. 8,500 workers lost benefits. 4,000 employees between the ages of 40 and 59, average tenure 23 years, received roughly 15 cents for every dollar they were owed. The remaining 2,900 with less than a decade of service received nothing. That was the first time a major American industrial company proved that the people who build the product are the last to be protected when the balance sheet fails. Today, the mechanism has evolved, but the architecture is identical. GM's Factory Zero in Detroit permanently laid off 1,100 workers. GM's Ultium cells plants in Lordstown and Spring Hill, the ones built specifically for the electric future Mary Barra promised, have more than 2,000 workers on layoff. Nissan has cut 9,000 jobs globally. North American and European auto suppliers have shed over 60,000 positions since the start of 2025. The signal was there. It had been there for some time. In the write-downs, in the production numbers, in the gap between announced capacity and actual output. The Indiana assembly worker who retooled for electric F-150 didn't make the capital allocation decision. Jim Farley did. The Lordstown battery plant worker didn't choose to build a facility sized for demand that never materialized. Mary Barra's strategic planning team did. The people who made the decisions kept their positions. The people who lived with the consequences lost theirs. That's the gap this industry has never closed. And it's the same gap Studebaker carved in 1963. Meanwhile, the competitive pressure isn't waiting for Detroit to recover. BYD delivered 2.6 million vehicles last year, commanding roughly 20% of the global EV market. China exported over 1 million vehicles to the European Union in 2025, and in early 2026, those exports accelerated by 62% year over year. Australia, A market with big roads, strong purchasing power, and no domestic auto industry to protect has become a preview of what happens when Chinese manufacturers compete on equal terms. They dominate on cost. And the $1.5 billion joint venture between Certified Automotive Lease Corp and Ares Management, formed in October 2024 to invest in new vehicle leases, tells you that private capital has already priced in the assumption that traditional manufacturers can't fund their own sales channels anymore. The board had the auditor's projections for 6 quarters before the write-downs were announced. No one in those meetings asked whether the demand forecasts had been independently validated. An estimated 400,000 additional used vehicles will enter the market in 2026 from off-lease returns alone, flooding dealership lots with supply at the exact moment consumers can least afford to absorb it. Total new car inventory in May 2026 stood at 2.89 million units, up 13% year over year. The cars are piling up. The buyers aren't there. And the companies that built the cars are carrying the debt that funded the factories that produced vehicles for a market that existed only in investor presentations. Verdict: Ford filed its restructuring. The models were killed. The $20 billion write-down appeared in the public record exactly as the internal projections had warned it would, and the executives who approved the original capital commitment remained in their roles when the loss was booked. 3 patterns emerge from this wreckage, and each one names a specific failure by a specific person. 1. Jim Farley's $50 billion electrification commitment at Ford was sized to match Tesla's valuation ambitions, not consumer demand data. The capital was deployed before the market existed to absorb it, and when demand stalled, the sunk cost was too large to pivot without catastrophic write-downs. The $163 billion in total Ford debt isn't a financing strategy. It's the accumulated weight of decisions made to impress analysts, not to build cars people would buy. 2. Carlos Tavares at Stellantis built an EV infrastructure across 14 brands simultaneously, a diversification strategy that required every brand to succeed for any brand to justify its allocation. When the market contracted, the write-down wasn't proportional. It was total. $25 billion in abandoned infrastructure from a company that had been profitable 12 months earlier. Tavares departed. The infrastructure remained, unsold and unmaintained. 3. Mary Barra's all-electric by 2035 pledge at GM created a binary commitment in an industry that required optionality. When GM scrapped the timeline and wrote down $8.7 billion, the Ultium plants became monuments to a strategy the company had already privately abandoned, while the workers staffing those plants were still showing up for shifts on production lines with no product to build. I've stopped assuming a board read what it voted on. This story is why. The industry didn't collapse from a single failure. It collapsed from synchronized certainty. Every major manufacturer making the same bet at the same time for the same reason, funded by the same cheap debt, validated by the same analyst consensus. When the bet failed, it failed everywhere at once. And the 60,000 supplier workers who lost their jobs, the Lordstown families whose plants went quiet, the Indiana line worker who retooled for a future that lasted 18 months, they didn't get a write-down. They got a separation notice. If you hold consumer discretionary funds, broad market ETFs, or any of the retirement vehicles that weight auto sector equities, the question worth sitting with
is whether the next capital allocation cycle at these companies will be driven by demand data or by whatever valuation narrative replaces the EV transition. Because the playbook hasn't changed, only the product has. The company that perfected this synchronized retreat mechanism is still operating. Its executives sit on boards you've heard of, from Tata Sons to Autoleave to McLaren. That story is next. The documents are public. Draw your own conclusions.